Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. You're not going to like what I'm about to say, but you do learn the most about yourself and your portfolio when the stock market is down. Okay, it's not fun. It's not a fun lesson to learn, but again, you do learn the absolute most about your business because when something goes down, you're like, oh, let me read about why this company is falling and let me decide whether I should buy, hold, or let things go. All right, so there are 3 key questions, 3 areas that you do want to pay attention to. Now, you may also be asking, like, how long is it going to take me to research a lot of this stuff if I'm new? Totally fair question. I had a great discussion on Public about it. I'll talk about that near the end of the video. All right, so let's go ahead and get started. So when you are a shareholder, when you invest in a company, you are an owner of that business. You need to make sure that business is good and in a place to grow, just like a flower. I want to make sure the soil is good. I want to make sure the weather is good. Make sure I'm doing everything I need to do to make sure that this business is in a good space to grow. So with that analogy, the first thing that I need to ask myself is, am I putting enough nutrients in? Are there enough customers, consumers, subscribers coming in at the top of that funnel to eventually get me paid, right? That's basically the first thing I want to ask. And a lot of this, we'll talk about Zoom and Netflix because those I think are the easiest things for people to wrap their minds around. So for example, Netflix is losing subscribers. That is a concern. Okay, that is a big concern. That might make me that would force me to consider to sell. Whereas on the other side of things, maybe a Salesforce, is Salesforce really losing consumers? Now both are down, right? Now Netflix is down like 70%, Salesforce is down like 24%. I might be okay with losing 24% in a world, normally you're never going to hear me say that, in a world where I am A, long-term investor, and B, the stock market is down 16%. Now, I don't own Salesforce, I don't plan on owning Salesforce, but these would be the things I am looking at. So if Netflix is losing subscribers and they're both in tech space, and Salesforce is not, Salesforce might be okay to hold on to, right? To buy today, I don't know, but to hold on to, hey, you're what, 6 points away? Not 6 points. You're 8 points away from where the stock market is as a whole. You know, that might not be the worst thing in the world, right? That's if, right? If you're consistently getting people in the door. So the second part of this is the environment. When we go back to the plant analogy, is the soil good, right? Am I planting this? Is it a desert around this particular tree and it's not a cactus? Or is this a place where you can actually grow things? Is the market and the economy in a good space for this company? Salesforce? Yeah, maybe. We'll see. Right? I don't honestly, I don't know. What I can tell you, it is not a great environment for Netflix. And it's not a great environment for Zoom, because when Zoom did well, as well as Netflix, but especially when Zoom did well, we were on lockdown, and all you could do was Zoom weddings, Zoom baby showers, Zoom meetings. We were all Zoomed out, right? That's what it was. It was the best possible opportunity for Zoom to absolutely win. That is not the case anymore. The environment has changed. The soil has dried up for something like Zoom. That is something that if I were invested in Zoom, honestly, I would have sold a long time ago. But now I know this is it. This is different, right? I'm not saying Zoom's going bankrupt or anything like that, but this is different. The environment is not what it used to be. I need to consider how I need to approach this. I could also consider that Microsoft Teams and FaceTime, for that matter, and then not Google, but Facebook has a video chat feature. All of these things are new competitors that I need to contend with if I am a Zoom. This is the environment now. Same thing with Netflix. I got Disney Plus and Hulu and whatever else is out there, Paramount, HBO, Apple TV, all those things. This was not the case in 2020, not to this degree, and it sure wasn't the case in 2019 or 2018. The environment has changed. You lose subscribers and the environment has changed. I got to look at those things, right? I have to look at those things and compare this and use this litmus test with every single investment that you own, with every single one, because the answers are going to be different. If I own Netflix, if I own Zoom, that answer is probably, hey, I need to just go ahead and let this go. If I own, let's say, a Target, if I own an Apple, if I own a Google, if I own an Amazon, these answers may be different, right? For Apple, they're still getting people. Their sales are slowing down, but they're fine, right? They're not losing people left and right, at least not to this point, but they're not losing people left and right. Amazon is also down, and it's down pretty bad. What I would do and what I will do, because I know y'all want me to do this, so we will talk about Amazon, that video is coming, but my question would be, is Amazon down because they're spending too much money, or they made a bad investment, or is it because people are canceling memberships and not ordering enough? They're not ordering what they used to order, or is it just inflation and expenses are just higher and it costs more for fuel to get package from point A to point B? Is it cost that's hurting you, or are people not ordering like they used to, or are people canceling subscriptions? If it's canceling subscriptions, that's concerning to me. I might sell Amazon, maybe. If its costs are going up and shipping costs are going up, shipping and fuel costs are going up, and that's making things more expensive, therefore you're less profitable, then hey, I think that's a temporary solution. I think in time that will fix itself. I would hold. Those two questions need to be answered, but that is the process, right? These are the things I need to ask myself as I'm going through this, and that's going to help me to make a better decision. So we're looking at the environment, in the economic environment around what is going on. We're also looking at whether or not you're actually gaining the most important thing, and that is customers. If you're gaining customers and the stock market is and the stock is down, that's fine. That's an overreaction, because I know in the end I'm gonna have more money, right, if my customers are consistently growing. If it's not and it's down, hey, you probably deserve that, right? It is what it is. You're not doing your main job, and that is getting more customers and retaining more customers. So the last thing I'm going to look at is time. How long is this environment supposed to last? How long is it expected to last? If I go back to Netflix and Zoom, I don't see us going back on nobody's lockdown no time soon. So Zoom needs to figure out how to not be a one-trick pony. That, in my view, is permanent. Something like a Netflix, that is something that is permanent. I don't see Disney Plus and HBO and whatever else folding up shop and saying, hey, we're just gonna not do this anymore. Now, some, like Quibi, some streaming services will fail. That's an absolute fact. But I don't see the environment going back to what it was, where it was just Netflix and Hulu and nothing else for the most part. That's something that you have to consider. I think that's a permanent thing. That doesn't mean that Netflix is going bankrupt, they're going to be the next Blockbuster or anything like that, but it is something I am going to consider. If I was used to Netflix being one of the top performers every single year, I don't think it's going to be the case anymore. I don't think it's going to be the case anymore because of competition. And if Netflix is raising prices and everything else is going up, somebody's going to get canceled here in this streaming service race, and we have seen that occur. So you got to be careful about that, right? So how long is this expected to last? If you are looking at maybe a bank, a JP Morgan, Capital One, is that situation expected to last forever? I don't really think so. If we hit a recession, which I hope we don't, we know on average recessions last about 18 months. Okay, now it doesn't mean that you have to hold on to the stock for 18 months or that it will even recover in 18 months. There's no guarantee in the case. But the economic stressors that we have right now, I think that tends to be temporary. 2 years is still temporary. It's long, right? But it is still temporary. Another really good example, better one actually, is the travel industry. In 2020, there was no travel. Airline stocks were falling left and right. We knew at some point we were going to get past the virus. We knew at some point people were going to travel more. That was a temporary thing, right? The environment right then wasn't great, but it was a temporary environment that we all thought that, hey, this is going to pass one day, right? And finally, it looks like we are getting right around to that point. So for airlines, hey, the environment has changed. Things might be a little bit better. Now, another part of that environment is oil and fuel prices are higher, so that's going to cut into your cost. So that's something you have to consider too. But just in an overall macro perspective, the environment there has changed, and that environment was temporary. So these are the things that you have to weigh. Every single investment in your portfolio is going to have a different answer. Everything in your portfolio is going to have a different answer. And honestly, these are the things that you want to ask before going into an investment. And definitely, if you're exiting, these are things that you want to ask. And everything, when I get ready to sell, these are a lot of the things I try and find out. Because again, especially when the market is down, and everything is red, like most things are, you have to sit down and decide, is this something worth holding on to that I'm going to thank myself in 3, 4, or 5 years? Or is this something that I will thank myself that I got out of And, you know, in 10 weeks, I'm going to thank myself. Or in 6 months, I'm going to thank myself. For example, for me, y'all saw that I got out of Disney. I said no. And y'all saw me get out of Block too. I said, look, the environment was changing. Things didn't go the way I expected it to. And I got out. And thank God I did, because both of those are down way more than the overall stock market. Yeah, I'm not going to be right every single time, but again, this process is to have you in the right spots more often than not. Now, last thing is, how are you going to have time to do this with every single stock that you own? Well, that depends, right? So the first thing is, remember, when I do my grading and I see somebody with 20, 25, 30, 40 stocks or more, I'm instantly concerned, because I know you probably didn't have time to research all those things for each one of those companies and then update them every quarter, or make sure they're in the right spots every 6 months. That's very difficult to do. So one, I would encourage you to check out my 3-step research process video. It's about a year old now, and you can research relatively quickly. But the other thing too is, you don't have to buy 40 stocks at once. And I think a better case is to build out a watch list, which is what I've taught y'all to do now, and to research over time. And then when you decide to buy, you can buy 3 or 4 at a time, or whatever it's going to be. So right now, like, I have a watch list. There are companies that I am interested in learning more about, and every day or so, maybe I'll read an article here or there, so that when I'm ready to buy and make some changes in my portfolio in June, I've been looking at them for weeks now. For weeks. It's not going to be something where I just woke up and say, boom, I want to go and buy this stock today. I've been looking at it for a while. I've been reading about it. I've read about a lot of the things that have been going on, and now I'm going to decide to buy. The other side is, you could say, look, I'm going to get really good at understanding 3 companies at a time. Every quarter, I'm adding more to my portfolio. So you may sit down and say, I'm going to learn about these 3 first. And then next quarter, I'm going to read about these 3 and add more. Now I have 6 stocks. Next quarter, read more, add 3 more stocks, and continuously add that way. 3 is just a number I threw out there. You can do 5, you can do whatever you're most comfortable with. But the key is really understanding all of those things about the business. Everything that you see me own on public, a lot of times I can snap off and rattle off what is going on with the business, what they do, what's good, what's bad, so on and so forth. But it's only because a lot of times, if it's on my watch list, I'm reading about it now. And once I get into it, it's because I've been reading and knowing about the company for months now. And also, for the companies I currently own, I've had them for quite a while. I don't buy and sell every single day. Y'all know I don't do that, right? And even when it is my moving day, I don't take out half the portfolio. It's usually 2 or 3 stocks here and there. So those are the things that you want to help you understand the time as a beginner. And it's okay. You want to buy 3 at a time and read and research and wait a few months to continue to add more. That's totally fine. Do what works for you. Also, watch that video, because it's really going to help you to tailor down, like, this is what I need to read and this is what I don't need to read, and make things very simple and easy for you, because you can do it. You absolutely can do it. And it is something that is a very valuable skill, because it can move you out of some things and help reduce some of the losses and some of the pain that you might be feeling right now, while also setting you up for the future. If I'm telling you now, if you are down, your portfolio is down 20, 25%, that's actually not the worst thing in the world. Okay, the market's down 16, you're within range, right? You're within range. That's not that bad. Now, if you're down 70 or 80%, you need to rewind this video and start over and really start to ask those questions of yourself and of your portfolio, and start to make some adjustments, because there's a difference, right? Because if you're down 70 or 80, that's a problem. And that's not a problem like red light sell. It's, hey, what is going on with the environment for this business? Is this something that is permanent or not? Because again, Salesforce is down 24. It's also in the tech space. Apple is down. It ain't down 70%. Why is it that Apple and Salesforce and others are down moderately compared to the market, while others are extreme? Like a firm was down 85%. We talked about that one the other day. That's extreme. So we need to see, what about this space? Is it because people aren't at home ordering stuff anymore on payment plans for a firm? Is that the thing? Or is it something else, right? So those are the questions you have to ask, and I can almost promise you is going to make you a better, more informed investor. All right, so last thing I'll talk about, if you want to support this channel and you like the work that we do Monday through Friday, I posted on Twitter the other day, we're on pace to do, I think it's almost 200 videos every single year. Okay, so this is not easy. So if you want to support the channel, make sure you go to buildingbread.com/blueprint. That is my book for Burning Blueprint. Juneteenth is coming around the corner, as well as the 101st commemoration or remembrance of the Tulsa Race Massacre. It means a lot to me to have produced that book. So make sure that you go and check it out. That's buildingbread.com/blueprint. You can get it on Amazon and almost everywhere else. So please come out, support the book, learn more about investing, and learn more about my hometown. All right, that's it for me. I'll talk to you later.